This equity market on Friday, 38.95 at a close on the S&P 500. Mike Wilson of Morgan Stanley says 3,900, easy sell. This is what he had to say to start the week. With both sell and buy side consensus so aligned, that look for a dip in the first half and a rip in the second half, everyone is starting to wonder how this view could be wrong. We think it's in the magnitude of the move lower, led by much weaker earnings and a Fed committed to fighting inflation. Mike Wilson says 3,900 is an easy sale. Krishna, Memani, I have to say, reading through your notes, you think the real pain trade here is an equity market that could get back to 4,500. Can you weigh those two risks for me?
Sure. So I think Mike, to some extent, may be right. That is, we are still very much in the trading range with respect to what the Fed is articulating as to their path forward. Having said that, given where positioning is, and if we get favorable data coming through over the next few quarters, the market is certainly not positioned for a 4,500 by mid-year. And I think that's why it will be the ultimate pain trade for the market at the moment.
That's the equity side of the story. Let's talk about the bond market side of the story. Marilyn, lining up to buy fixed income in 2023, almost every single investor I've spoken to. Marilyn, what's the risk that yields actually go against that view?
Well, so I think we're certainly in a far better position than we have been, at the beginning of last year. And I think given the massive repricing that we saw last year, fixed income, I think, is a relatively attractive asset class now. Particularly, I think, when you talk about risks, we like the carry and the income that you can get, particularly in sort of the risk-free area of the bond curve. So if you look at the front end in treasuries, when you look at little or no duration in terms of high-quality investment grade and other asset classes, maybe in the MBS market as well, then I think actually there are a lot of attractive opportunities. And the key there, I think, is to really understand the liquidity, is to understand the risk-reward dynamics, it's to understand the impact of the duration, and to really focus on those aspects where you can really get some very, very decent carry and some decent returns. But you are looking at relatively low risk, even if you do see a change in the interest rate dynamics. And I think that's the key, to really make sure that you're not overly interest rate sensitive in your portfolio.